She did everything right. That is the part that makes this story worth telling. Starting at 24, she moved $400 into a savings account every single month without fail. She skipped vacations other people were taking. She said no to things she could have easily justified buying. By 32, she had saved $38,400. 8 years of discipline, compressed into a number she checked every few weeks and felt proud of. Then she sat down one weekend and looked at what that $38,400 could actually buy now compared to what it would have bought the day she started. The down payment she had been saving toward had moved further away from her, not closer. 8 years of consistent, deliberate, responsible saving, and the goal was farther than when she began. The money was there. The purchasing power was not. Warren Buffett has written about this problem for 50 years. In his 1977 annual letter to Berkshire Hathaway shareholders, he described in precise terms what happens to a person who saves in instruments that earn less than the rate of inflation. The balance grows, the account looks healthy, the numbers only go up. And the real value of those numbers, the actual purchasing power, what the money can trade for in the real economy, falls every single year the account earns less than prices rise. The average standard savings account at a major U.S. bank today pays approximately 0.45% in annual interest. The Federal Reserve's own target for inflation is 2% per year. In recent years, actual inflation has run between 3 and 4%. Every year you hold money in an account earning less than inflation, you are losing ground. The question is not whether this is happening to your savings. The question is how much it has already cost you. Most people think of saving money as the responsible thing to do, and they are right in one specific sense. Spending less than you earn is the foundation of every real financial outcome. But somewhere between the instinct to save and the decision of where to put what you save, a critical distinction gets missed. Saving is a behavior. A savings account is a tool. And the tool most people reach for, the standard bank savings account, the familiar one with the branch on the corner, is not built to preserve your wealth. It is built to hold your money safely in nominal terms, while real purchasing power quietly disappears. Discipline is not the problem here. The destination is the problem. And for most of the people watching this, the destination has been wrong for years. If understanding how money actually works, not the surface version, but the real mechanics, is something that matters to you, subscribe to this channel and hit the notification bell. This is where we break down what the financial machine actually does, in language that anyone can follow. Let me show you exactly what the savings account has been doing to your money, in numbers that do not require any financial background to understand. In 2014, the average interest rate on a standard savings account at a major U.S. bank was approximately 0.06%, 0.06%, barely distinguishable from zero. By 2024, after the Federal Reserve raised interest rates to their highest level in decades, the average savings account at a large bank was paying approximately 0.45%. During that same 10-year period, the Consumer Price Index, the government's official measurement of what things cost, rose by approximately 33%. A grocery cart that cost $100 in 2014 cost approximately $133 in 2024. The savings account balance grew by less than 5% over those 10 years. Prices grew by 33%. Those two numbers are not the same story. What does this actually cost someone who saves consistently? Take a person who deposits $500 every month into a standard savings account, earning 0.45% annually. After 10 years, they have contributed $60,000 of their own money. The interest earned on that balance, compounding monthly, adds approximately $1,400 over the decade. Total account balance, roughly $61,400. Now calculate what $60,000 in purchasing power at the start of year 1 would need to become at the end of year 10, just to keep pace with 3% annual inflation. The answer is approximately $80,600. Their account has $61,400. What they needed to maintain real purchasing power was $80,600. The gap between those two numbers, nearly $20,000, was not taken by a market crash. It was not taken by a bad investment. It was taken silently by the difference between what the account paid and what inflation cost. 10 years, $20,000, quietly removed. No notification, no event, no day where the balance went down. The number only ever moved up. The real value only ever moved in the other direction. Extend that same math over 30 years, a full working career from age 25 to age 55, and the difference becomes difficult to look at directly. $500 per month deposited into a savings account earning 0.45% for 30 years produces a final balance of approximately $188,000. $500 per month invested in a low-cost S&P 500 index fund, earning the historical average annual return of approximately 10% over those same 30 years, produces approximately $1,130,000. The difference between those two outcomes, $942,000, was generated by the same amount of money, deposited at the same pace, over the same period of time. The only variable was where it went. The person who invested in the index fund did not have a smooth experience over those 30 years. They watched the account fall 36% during the dot-com collapse of 2000 to 2002. They watched it drop 57% during the 2008 financial crisis. At multiple points along the way, the number on their screen was dramatically lower than it had been the month before, and there would have been every psychological reason to move to cash, to stop watching the losses, to find something safer. The people who did not move are the ones who ended up with $1,130,000. The discomfort was real at every low point. The temporary losses were real. And none of that changed the 30-year outcome, because the thing that erased every loss and compounded above them was not skill or timing. It was time. The person who chose the savings account did not lack discipline. They had more of it than most. They deposited money every single month for 30 years and never missed a contribution. They did not spend recklessly or fail to make good decisions in any other area. They lived within their means, protected their balance, and made the choice that felt safest every step of the way. They simply directed extraordinary discipline at the wrong instrument for the wrong time horizon. The result was $188,000 instead of $1,130,000. The discipline was real. The sacrifice that funded those deposits was real. The destination was wrong. And in building wealth over decades, the destination is almost everything. If this math is shifting something, if the numbers are starting to look different than they did before, write in the comments, "I am moving my money to work." That is the comment that tells me this reached the right person at the right moment. To understand why this keeps happening, why savings accounts consistently underperform inflation year after year, you need to understand that it is not an accident. The Federal Reserve has an explicit, publicly stated target: 2% annual inflation, not 1%, not 0. 2. This target has been official policy for decades and is considered a foundational principle by virtually every major central bank in the developed world. The reasoning is direct. Moderate, predictable inflation discourages the hoarding of cash by making idle money lose value over time, which in turn encourages spending, investment, and economic growth. If prices were consistently falling, deflation, the rational choice would be to wait before buying anything, because everything gets cheaper over time. The 2% inflation target is not a failure of economic management. It is working exactly as designed. And it means that every dollar sitting in an account, earning less than 2%, is losing ground by deliberate policy, not by accident. Think about the last time you checked your savings account balance. The number was higher than the month before, maybe by a small amount, maybe by a larger deposit. The balance confirmed that you had been responsible. It rewarded the behavior, and somewhere in that confirmation was a feeling of security that account balances create very naturally. The number went up, therefore things are getting better, therefore I am moving forward financially. What the balance did not show was the real value of that number. The purchasing power it represents, what those dollars could actually trade for at that moment compared to 12 months earlier. The account reported faithfully on the nominal count of dollars. It said nothing about what was happening to the underlying wealth those dollars represent. The confusion between nominal value and real value is one of the most expensive misunderstandings in personal finance, and one of the most persistent. Because nominal value is what every financial statement shows you. Your savings account shows you a number. Your bank statement shows you a number. The FDIC insurance protects a number. None of those systems report on purchasing power, on real value, on what the number can actually buy. Nominal value is the count of dollars. Real value is what that count can purchase. A savings account guarantees the nominal count. It makes no promise and cannot make any promise about the real value. You can hold a savings account that is completely protected in nominal terms and still be getting poorer every year the account earns less than the inflation rate. Both of those things are simultaneously mathematically true. The word savings does real damage here because it creates an expectation the account cannot fulfill. When you hear savings account, the word savings implies that what is being saved is actually preserved, that the act of saving protects and maintains the thing being saved. What a savings account actually does is preserve the nominal count of dollars while the purchasing power of those dollars erodes at whatever rate exceeds the account's yield. If your account pays 0.45% and inflation runs at 3%, the account's real return is negative 2.55%. The balance goes up. The wealth it represents goes down. A more accurate name for this financial product, one that would create more accurate expectations in the people using it, would be a slow loss account. The dollars are insured. The wealth they represent is not. In his 1977 letter to Berkshire shareholders, Buffett described an individual who had saved responsibly for decades, holding money in instruments that were safe in nominal terms. The balance was real, the FDIC protections were real, and the purchasing power of what had been carefully accumulated had been quietly and systematically reduced by the gap between the interest the account earned and the inflation the account's holder endured. Buffett's point was not that saving was a character flaw. His point was that saving in instruments that earn less than inflation is not actually saving at all. It is a slow, invisible transfer of wealth from the person who saved to everyone whose capital is placed in something that outpaces rising prices. The arithmetic of this is not complicated. If your savings account pays 0.45% annually and inflation averages 3%, your real return is negative 2.55%. Negative. Every year. On every dollar currently sitting in that account, this is not a prediction about what might happen under some future economic condition. It is math about what is already happening to every dollar in an account that earns less than prices are rising. The balance grows. The wealth it represents shrinks. And because the balance is the only number visible on the screen, the shrinkage is invisible. Until the day you go to do the thing you were saving for and discover it now costs more than your balance can cover. If this is clarifying something that has always felt slightly off about the savings account, If the numbers now make sense in a way they did not, let me know by liking this video. It tells me this content is doing what it is supposed to do. If saving in a low-yield account is a slow loss, what does Buffett himself do with money that is not immediately deployed into a business or investment? The answer is more specific than most people expect. As of 2024, Berkshire Hathaway holds approximately $320 billion in cash and short-term investments, a position that looks from the outside like an enormous reserve of idle cash. But that cash is not sitting in a standard savings account at 0.45%. It is held almost entirely in U.S. Treasury bills, which have yielded between 4 and 5% during periods of higher interest rates. When short-term yields fall below a threshold Buffett considers acceptable for idle capital, he shifts those funds into equity positions instead. Capital that is not deployed into a business is deployed into the highest-yielding safe instrument available. It is never left in a place where it loses ground to inflation while waiting. This distinction is everything. Buffett does not hold cash because cash is safe. He holds cash so that Berkshire can act when no one else can. In 2008, as most investors were selling under pressure and markets were collapsing, Buffett deployed billions into Goldman Sachs, General Electric, and other major companies at terms that only someone with immediate, fully liquid capital could have negotiated. He could do that because his idle capital was earning while it waited, in T-bills, not in savings accounts, and it was available the moment something better appeared. That is the function of liquidity managed correctly, not a resting place, a staging area. Capital earns while it waits and moves the moment the right opportunity presents itself. Look at how Buffett has handled his own money throughout his entire investing life, and the pattern is unbroken across more than 80 years. He bought his first stock at 11 years old, 3 shares of Citi's Service Preferred at $38.25 per share. He was not putting that money in a savings account to accumulate it. At 16, his savings from a paper route, a pinball machine business, and other small enterprises were equivalent to tens of thousands of dollars in today's terms, and every dollar of it had already been converted into some form of productive asset by the time he was thinking about the next one. His operating principle has never changed. Money sitting in an account is not working. Money deployed into something that produces real returns, a business, an equity position, any productive asset, is working. The goal has never been to accumulate dollars. The goal has always been to accumulate assets that produce more than inflation takes. The irony here is painful to see clearly. The people who suffer most from the savings account problem are not the reckless ones. They are not the people who spend carelessly or skip deposits. They are the careful ones, the disciplined ones, the people who genuinely sacrifice to build up a balance every month, who check the account, who feel the satisfaction of watching the number grow. These people do not have a discipline problem. They have a direction problem. The discipline that is producing the slow loss is the exact same discipline that, pointed at a different instrument, would produce the very different 30-year outcome the math shows. The obstacle is not behavior. The obstacle is destination. Disciplined, consistent, responsible, eroding, month after month, year after year. A savings account doing exactly what it was built to do, and doing exactly what makes it the wrong tool for the job. If the gap between understanding this and actually doing something about it is the part that feels stuck, the first pinned comment below this video is there for you. It is for people who are ready to stop understanding the problem and start moving past it. Now let us address the objection that is already forming. What about emergencies? What if I need this money next month, or the market drops 40% and I cannot wait years for a recovery? This objection is the correct one to make, and it points to a distinction that most financial content never makes clearly enough. There is a fundamental difference between an emergency fund and long-term savings. They are not the same thing. They do not belong in the same account. They should not be managed with the same logic. An emergency fund is money you might need within the next 3 to 12 months, at unpredictable moments, without warning. That money should be liquid and immediately accessible. A high-yield savings account paying 4 to 5% at an online bank or credit union is exactly the right tool for it. 3 to 6 months of actual monthly expenses, no more than that. That is the emergency fund. That is what belongs in a savings account. Everything beyond that threshold, every dollar that does not need to be accessible within the next 12 months, is not an emergency fund. It is long-term savings that has been sitting in an emergency fund account out of habit, inertia, or the undifferentiated sense that all money should go to the same safe place. This is where the real cost accumulates. Long-term savings held in a standard savings account earning below inflation is not financial safety. It is the slow erosion of wealth that has already been earned, held in a place where the erosion is invisible until it has already happened. The emergency fund stays in the savings account. Every other dollar belongs somewhere that compounds faster than prices rise. The second objection is the market crash argument. The S&P 500 fell 49% during the dot-com collapse. It fell 57% during the 2008 financial crisis. If someone had their retirement savings entirely in the market in 2008 and needed access to that money in 2009, they were in genuine trouble. This is a real risk, and it deserves a real answer. The answer is that market volatility is genuinely dangerous for money you will need in the short term, and that is exactly why the emergency fund exists. For money with a 15 or 30-year horizon, the relevant question is different. The question is not, could the market drop while I need this money? The question is, will I actually need this money in the next 5 years? If the answer is no, and for most people, most of their savings beyond the emergency fund can answer no, then the mathematical certainty of inflation erosion in a savings account is a larger long-term threat than the statistical likelihood of a market decline that does not recover before the money is needed. What does someone who is starting from zero actually do? First, build the emergency fund. 3 to 6 months of real monthly expenses, not an optimistic estimate of what you spend, but an honest one, held in a high-yield savings account at an online bank or credit union where the rate is 4 to 5% rather than 0.45. This fund has one job and one job only: to be there when something goes wrong. It is not an investment, it is insurance. Second, once that fund is fully built, every dollar that is not emergency money, every dollar that does not need to be accessible in the next 12 months, goes into a tax-advantaged investment account, a 401k if your employer offers one, a Roth IRA, both if your income allows it, invested in low-cost index funds. The emergency fund protects you from short-term volatility. The investment account is built for time. The S&P 500 has returned an average of approximately 10% per year since its inception in 1926. Not every year at 10%. Some years it returned 32%. Some years it lost 50%. But over every recorded 20-year rolling period in its history, it has recovered every loss and produced a positive cumulative return. Buffett's will, the legal instructions for what happens to the assets he leaves behind, directs the trustee managing money for his wife to put 90% of the bequest into a low-cost Vanguard S&P 500 index fund. Not hedge funds, not individual stocks, an index fund. The person who designed one of the largest fortunes in history over a lifetime of investing chose the simplest, most accessible financial product available to ordinary investors for the people he loves most. That is not an accident. That is his clearest specific recommendation. In 1972, Berkshire Hathaway purchased See's Candies for $25 million. See's makes chocolate. It has done so since 1921. It does not require a technology revolution or a reinvention of its business model every 5 years. It produces something people want, sells it at a price that reflects its quality, and generates consistent profit year after year, regardless of what the dollar does in a given period. Since that purchase, See's has produced over $2 billion in cumulative profit, money that Buffett has redeployed into other businesses and equity positions, compounding forward decade after decade. The principle the purchase illustrates is direct. A business that earns real returns, cash flow that exceeds inflation, preserves and grows purchasing power in a way that a bank account earning less than inflation can never do. Own productive assets. That is the alternative. You are probably thinking, I am not buying a candy company. I do not have $25 million. I have a few $100 available after bills, and a savings account I have been putting money into for years. What does any of this have to do with my actual situation right now? The principle is the same. The vehicle is different. The principle is own something that generates real returns rather than hold something that erodes real value. At a few $100s per month, the vehicle is a low-cost S&P 500 index fund through a brokerage account. Vanguard, Fidelity, and Schwab all offer index funds with zero minimums and zero commissions. The asset inside that fund is a fractional ownership stake in the 500 largest companies in the United States. The same companies that have driven economic growth through recessions, financial crises, pandemics, and every other disruption of the last century. The access exists. The minimum is zero. Warren Buffett started accumulating assets at 11 years old. At 16, his savings from a paper route, a pinball machine operation, and other small businesses were equivalent to tens of thousands of dollars in today's terms. At every stage of that process, money he earned was converted into a productive asset as quickly as he could identify one worth purchasing. He did not wait until the amounts felt large enough to justify investing. He did not hold the money in a low-yield account while deciding, capital goes to work or it is losing to inflation. That principle has been consistent across 8 decades and across every order of magnitude, from a teenager's paper route profits to Berkshire's $320 billion cash position. Berkshire Hathaway became what it is not because Buffett made extraordinary decisions available only to a genius. It became what it is because he applied one operating principle without interruption for 60 years. Capital deployed into productive assets at reasonable prices compounds. Capital left idle loses to inflation. The 60-year consistency is the entire mechanism. The arithmetic of compound growth on non-eroding capital is the entire result. The number to $130 billion is what 6 decades of the same principle, applied without interruption, produces. The principle does not change with the size of the capital. The math is identical at $500 per month as it is at 500 million. The version of financial responsibility most people were taught, save your money, keep it safe, do not take unnecessary risks, is not wrong in its instinct. Living below your means and protecting what you have earned are foundational behaviors. What is wrong is the specific definition of safe that gets attached to the savings account. A savings account is safe from one specific kind of loss: a bank failure, a sudden disappearance of the nominal balance. It's protected from that risk up to $250,000 by FDIC insurance. It is not safe from inflation. It was never designed to be. That protection was never offered. Applying the word safe to a savings account the way most people mean it Safe as in wealth preserving, safe as in my purchasing power is protected, is assigning a guarantee the product cannot deliver. The account is safe from a bank run. It is not safe from the slow drain that inflation runs on every dollar earning less than the rate of price increase. Real financial safety is purchasing power preservation. It is the ability of your money to buy the same amount or more in the future as it can buy today. The only way to achieve that over time is to earn a real return, a return that exceeds inflation. A savings account earning less than inflation does not do that. The stock market, over any sufficiently long time horizon, consistently has. Real estate over long horizons has. Ownership of productive businesses, directly or through index funds, has. The risk of volatility in those assets is real and worth accounting for. The certainty of erosion in a savings account earning below inflation is also real and worth accounting for with equal seriousness. Choosing between them is a choice between two different kinds of risk, one that is visible and temporary, one that is invisible and permanent. The risk of losing money temporarily, the certainty of losing purchasing power slowly. One shows up on your screen as a red number during a market correction. One shows up as a grocery receipt that costs more than it did 2 years ago. One triggers alarm. One triggers nothing. Over any time horizon long enough to matter for wealth building, only one of them is your actual long-term enemy. There is a conversation Buffett could have with someone who has been saving diligently in a low-yield account for 15 years. A version where he sits across from them and says the discipline was real, the monthly deposits were real, and the tool you trusted with that discipline delivered you the opposite of what you needed from it. Your balance is larger than when you started. Your purchasing power in real terms is smaller. The money is there. The wealth it once represented has been slowly transferred to everyone whose capital was deployed where yours was not. The discipline deserved better than the destination delivered. Changing the destination now, even 15 years in, produces a different outcome than continuing the same pattern for the next 15 years. Where does someone start if they have been keeping money in a savings account for years and want to redirect it? The answer does not require moving everything at once. It requires being honest about which part of that balance is actually an emergency fund, money that could realistically be needed in the next 12 months, and which part has just been accumulating there because no one ever clearly explained where else it should go. The emergency fund stays. 3 to 6 months of expenses, earning the best high-yield rate available. Everything above that, the dollars that have been sitting there not because you might need them but because inertia kept them there, is what gets moved into a Roth IRA, into a 401k up to the employer match, into a taxable brokerage account holding a low-cost index fund. Slowly, if that is what it takes, consistently, into instruments where time works for you. What does someone who does this correctly look like 30 years from now? They maintained a fully funded emergency fund throughout their entire working life, 3 to 6 months of expenses in a high-yield account, available the moment anything went wrong. That fund gave them the stability to keep long-term investments untouched through every market cycle, because short-term financial disruptions had their own dedicated tool. And they invested every dollar above that threshold into tax-advantaged accounts holding low-cost index funds, contributing consistently, not touching them through multiple recessions and recoveries. At retirement, after 30 years at 10% average annual return, the total across those accounts is between $4 million and $5 million, built from ordinary income on an ordinary schedule using tools available to any person with an internet connection and a monthly deposit. The emergency fund protected them when things went wrong. The investment account built the life they were working toward. The tools to do this have never been more accessible than they are right now. 20 years ago, Opening a brokerage account required a minimum investment of several $1,000s and a phone call to a broker who charged commissions on every trade. Today, Vanguard, Fidelity and Schwab all offer index fund accounts with zero minimums, zero commissions, and complete access from a phone. The barriers that once kept ordinary investors out of the same instruments that compound for people like Buffett no longer exist. The only barrier remaining is the belief, taught early, reinforced constantly by the appearance of a balance that only goes up, that the savings account is safe and the alternative is dangerous, when the actual arithmetic over any meaningful time horizon runs in the other direction. The point of this video is not that savings accounts are bad and you should never use one. The point is more specific. A savings account is the right tool for money you might need in the next 12 months. It is the wrong tool for money you will not need for 5 or 10 or 30 years. When you use the emergency fund tool as a long-term wealth vehicle, when the discipline of saving every month produces a balance that is quietly losing ground to inflation year after year, the cost is real, and it compounds against you the same way a good investment compounds for you. Calculate what that gap costs over your specific time horizon. Understand the real return your savings account is actually delivering. Then put the long-term money in an instrument designed for the long term. The emergency fund handles uncertainty. The investment account builds what comes after it. If this video shifted how you see the savings account, if you are looking at the distinction between emergency fund and long-term savings with different clarity than you had 20 minutes ago, write in the comments, "I am redefining safe." There is another video on your screen right now. We will see you in the next one.